Indexing allows you to participate with the upside in the market, but not lose when the market nosedives. In this episode, I'm going to address the question, how does indexing work with universal life? Get ready. You're going to be blown away with information that many financial advisors don't even know. Hi, I'm Doug Andrew. I've been a financial strategist and retirement planning specialist for more than 46 years. I've been helping people optimize their financial assets, minimize unnecessary taxes, and empower their authentic wealth for 4.5 decades. And my favorite vehicle to help them accumulate their money tax-free, then be able to access that money anytime, not even at retirement, in their 30s, 40s, whenever, totally tax-free. And then when they ultimately pass away, to have it blossom, increase in value, and transfer income tax-free is what I affectionately call the laser fund. Now, I've written a book called The Laser Fund because it explains what a laser fund is. Laser is an acronym that stands for Liquid Assets Safely Earning Returns. Because the laser fund, which is the max funded indexed universal life insurance policy, if it's structured correctly and funded properly, it will allow you to be able to accumulate your money totally tax-free. And I've earned average returns between 6 to 10% tax-free for decades using this. But when it was first introduced in 1980, it was just universal life. And from 1980 until 1997, for the first 17 years, universal life being on the market, I averaged about 8.2% because the general account portfolio rates of the insurance companies were between, 11.75% and 15.5% from 1980 to 1990. Then interest rates started coming down, and interest rates are relative. When interest rates are high for earning, they're high for borrowing. Mortgages back in the 1980s were as high as 18 and 21%. But see, when interest rates came down, banks only paid maybe 1%. Most portfolios of insurance companies on their AAA and AA bonds, on the mortgages they have on skyscrapers and shopping malls and what have you, were more in the 5, 6, 7% range. And so that's when indexing was introduced in 1997. And when I saw that, I said, wow, this is a way to participate with the market and earn higher rates of return, but when the market crashes, not to lose. So let me explain indexing in a very simplified manner so that you can understand this, because frankly, I could stump a lot of financial advisors out there like Dave Ramsey, Susie Orman, Rick Edelman, David Bach. I know all these people personally, and they've never been taught this. When I say indexing, they think I'm talking about index mutual funds. No, that just means you're putting money in a mutual fund that is invested in the S&P 500 index. You will lose maybe 40% like 2008 if you use indexed mutual funds. I'm not talking about that. I didn't lose one dime due to that market crash in 2008 using indexed universal life. So watch how I explain this simply so that you can understand how dynamic this is. Once you get it, you'll understand why I've averaged between 7 to 10% internal rates of return ever since 1997. So I'm going to use an example of $1 million of cash value in an insurance policy, an indexed universal life. Now, if you are just starting out and you're putting in $500 a month or $1,000 a month, you don't need huge lump sums. Many times people would come to me with $500,000, and when they had it maximum funded, the $500,000 would double about every 7.5 years, averaging 9.6%, as you're going to see. The $500,000 they put in would double to $1 million in 7.5 years. That million would double to $2 million in another 7.5 years. The $2 million would double to $4 million in another 7.5 years, and the $4 million doubles to $8 million in another 7.5 years. And so people who started out with $500,000 without adding a dime, 30 years down the road have $8 million. And these people are generating $800,000 a year of interest income Many of them don't even need that much. So they only take out $300,000 or $400,000 a year of tax-free income, and the rest is compounds tax-free. So let me show you how to do that, because many financial advisors who think they know what I'm talking about, and they really don't know what they don't know, because you can't be aware of something you're not aware of. They go, I've never seen an insurance policy do that. I go, well, you haven't seen the ones that have been designed to do this. I can show you hundreds and thousands of clients who have earned rates of return averaging between 6 to 10% during the last 20 years, since 1997 when indexing was first introduced. So let me talk about the general account portfolio of the insurance company. Legal reserve insurance companies have to have reserves on hand that are liquid and safe, so that if there's like a run on the bank, so to speak, a panic or whatever, that if people need their money, they can liquidate it. And so they have legal reserves that are far more stringent than banks and credit unions. So where is that money? Some insurance companies, of course, have billions of dollars. One of the companies I put my money into manages about $3 trillion. Do you know how much money that is? That's about as much as the IRS collects in income taxes in an entire year. One insurance company, okay? This is called the general account portfolio yield that they report every year that they're earning on all of their assets. Now, most insurance companies have maybe 15, 20% of their money in AAA and AA bonds. Maybe another 15 or 20% in mortgages on shopping malls and skyscrapers and so forth. Very little of their money usually is invested in stocks. If it is, it's in very stable stocks. When you look at the general account portfolio of these insurance companies for the last 30 years, the average yield has been maybe between 5% up to 17%. The 17% was more like the high interest rates of the 1980s when universal life was first introduced. The average for me, for my lifetime, ever since 1980, for 40 years, has been more between 8 and 9%. Now, the last 10 years, I was showing this illustration during the worst decade since the Great Depression. And so when I talk about the last 10 years, this is the worst 10-year period, 2000 to 2010. From 2010 to 2020, I've actually earned a little bit higher rates of return, but I like to use the worst decade. During that time period, the general account portfolio rate was usually 6% or a little higher. So if the insurance company was earning 6% on their billions or $1 trillion of assets, they need about one of those percentage points for them, for a profit. They're in business to make a profit. This is the net. And so 5% is what I earned on my money. So let's say I have $1 million of cash value at this point in time. I'm going to use a snapshot, and I have $1 million in my universal life policy. Now, the neat thing about indexed universal life, you can anytime just settle for the general account portfolio rate. That would be 5% here. So let's say if I feel bearish about America, I think we're headed for a recession or something, I can just say, you know what, just pay me 5%, that's $50,000. Now, it's tax-free. If I leave it there, now I have $1,050,000 at the end of the year, and it's compounding. If I take it out, it's tax-free as income. That's the beauty of universal life insurance. If the $50,000 is the general account portfolio rate, I can just settle for that, and that's maybe good advice when the economy is tanking, because you're earning at least 5% instead of having your money at risk in the market. But anytime I feel bullish about America, then I can opt to link to an index. And so many times, especially during election years, I do this. So in 2011, when Obama was running for his second term, he's an incumbent running for his second term, I know that whether you're Republican or Democrat, you're going to try to make the economy look vibrant, booming, dynamic, with all kinds of fiscal and monetary policy. So I knew my chances were better than not that the economy would grow faster than the 5% rate. So I linked to an index back in 2011. I do that during election years, and you sort of can tell that this isn't rocket science. So let's say you linked to an index. So let's use the S&P 500. So if you link to an index, here's the key. If the S&P were to go up 10% that year, The insurance company must pay you 10%. If the S&P was 1,000 at the beginning of when you said link, and this isn't a calendar year necessarily. So for example, in 2011, November 15th, I said link. So 1 year later, November 15th of 2012, just after the election was over, okay, if the S&P was 1,000 and a year later it was 1,100, that's a 10% increase. Do you understand? They must pay me $100,000. They're contractually obligated. They can't get out of that. Now, some people say, how can the insurance company afford to do that? Well, they're big boys and girls. They know what they're doing. Here is the key. Listen very close. This is what many financial advisors do not understand. When I have $1 million in the insurance company and I opt to link to an index, I am not authorizing the insurance company to take one dime of my $1 million and put it at risk in the market. My $1 million is not invested in the S&P 500. Okay? Where is it? It's in the insurance company, safely tucked, earning 5. Well, how can they afford to pay me 10? Because I'm authorizing them, I'm relinquishing the for sure 5, that 50,000. They're earning 50, and I'm saying, don't you dare mess around with my principal of $1 million. You can take the interest on my $1 million and do whatever you need to do to have the wherewithal to pay me whatever the S&P does. Well, this is not rocket science. What do they do with the 50,000 of interest? They buy upside options in the index or indices I chose. That would be in the S&P 500. So they buy upside options. They're the #1 purchaser of options in the world, this particular insurance company. And so 50,000 of options, if the market goes up, that easily doubles to 100,000. They can afford it because it made double with those options. If it went up to 15%, they pay you $150,000 because 50,000 will triple to 150,000. It's not how can the insurance company afford to do this? They're just buying upside options. Well, what's the trade-off? If I guessed wrong and there was a terrorist attack in 2011 and the market tanked during 2012, the options expire worthless. But I don't lose my $1 million. If my $1 million was in a variable insurance policy, if my $1 million was in the market, like 2008, it would have been only worth $600,000. But in 2008, I didn't lose my $1 million. It was safe. I didn't make anything because the options expired worthless. But I made money if the market went up. And in 2011 to 2012, I actually made $160,000, 16%. But see, the insurance company has to cap you because they don't have your full $1 million to be invested in the market. You've told them, no, you want to be safe. They only have the interest on your $1 million. So they cap you at 15 or 16%, sometimes 25%, sometimes 12%. They cap you. The trade-off is 0 can be your hero if the market loses because you don't lose. Does that make sense? So what does it all mean? The worst decade since the Great Depression, 2000 to 2010, when most Americans were still down about 38%. It took till 2012 before their $1 million came back to break even. Many of our clients using indexing tripled their money during that time period. But from 2000 to 2010, you would have at least doubled your money. Here's how. With a 0% floor, okay, you don't make money some years, I bet you don't lose. And a 15% cap. The caps were 16 to 17 back then, only at 15% the last year, 2009 to 2010. But I brought it down to that. Your average would have been 7.23%. If you know the rule of 72, that means your money doubled. $1 million doubled to $2 million tax-free when most Americans barely were back up to 630,000. It took 2 more years before they had their $1 million back. In that 2 additional years, the $2 million went to $3 million because I used diversification and rebalancing. What's that? This is where you can diversify. This is one option here. This means 5 years I earned 0. The other 5 years I earned whatever the index did, but only 2 of those years did I cap out. That's the average of this. But this insurance company has 15 different indices to choose from. Here's one. I can choose a 2% floor so that I'll make 20,000. They have to keep 20,000 on hand to make sure I have 20,000 or a 2% return if the economy loses. They only have the remaining 30,000 or 3% to buy upside options. So they lower the cap to 13%. The higher the floor, the lower the cap. Using that one for 30 years, you would have averaged 8.11%, okay? Here's another one. I can take the floor back down to 0 and allow them to use the entire 50,000 to buy upside options. But they'll keep me at a 13% cap on this one. You say, well, why would you do that? Because the insurance company on this one will pay me 140% of whatever the S&P does. If the S&P, if it's 5, they pay me 7. If it's earning around 9, 10, I will cap out at 13. And so this is for the volatile markets that just go up and down in a general zoner area. People say, well, Doug, which one did you use? All of them. Here's why. I diversify. So I could allocate on this million, 300,000 to this one, 300,000 to this one, 300,000 to this one, and the last 100,000, just leave it in there earning 5. Many people do that. Some people diversify and take 20% and assign it to one of 5 indices, or maybe the last 20% is in the general account portfolio rate. I'll show you one of those. But see, by diversifying, I was able to earn 9.62%. I can also rebalance, which means I don't have to sit there and earn 0 5 of the 10 years. If the economy begins to go down because of a terrorist attack or the mortgage meltdown of 2008, I just say, you know what, move me back over and just pay me the 5% rate. So in actuality, I didn't earn 0 for 5 of those 10 years. I only earned 0 2 of the 10 years. The other 3 years that I would have earned 0 had I not rebalanced, I earned 5. And the others, when the market turned around, I went ahead and linked. That is how I've been able to tweak my rates of return to 9.6, 10.07, and that's net cash on cash rates of return for many of those time periods. So when a client gets their annual statement, this particular client had all of these indices to choose from. These are the 5, and they diversified their money. And look at this. On 20% of their money, they got 13.65 that year, 11 that year, 9.5 that year on that one, 15 on that one, and they left 20% of their money in the general account portfolio, which in that year was 4.4. The average of all of those was over 10% rate of return. So the whole message here is that you can have your money linked to the market without your money at risk. This has to stay safe. In the insurance company, earning 5. When you relinquish that and say you can do whatever you need to do, they buy upside options. That's what gives them the wherewithal. The insurance companies know what they're doing. They can afford to do this because the options will double and triple. But if the economy tanks, the only thing that happens is the options expire worthless, but you don't lose the principal you started with that year. And every year you make money, that is locked in and reset, so you do not lose in future years the money you made in previous years when you use indexing. If you want to learn more about this, I would recommend that you get a copy of my most recent best-selling book, The Laser Fund. Let me show you how you can claim your free copy. If you simply go to Laser Fund, L-A-S-E-R, fund.com, you contribute $5.95 towards the shipping and handling. I'll pay for the book. It's 300 pages, charts, graphs, explanations, and actually on the other side is the right brain client stories showing you examples like I've alluded to here of actual clients who have averaged returns between 6 to 10% tax-free for 10, 20 years ever since 1997 when Index Universal Life was first introduced. So I invite you to learn, and you'll have options there to be able to listen and learn and watch and learn. Go to laserfund.com.